If you've been saving money into a pre-tax retirement account over the course of your career, the federal government was nice enough to give you a tax break on those contributions. But the federal government's not going to forget about those tax breaks that it gave you. At some point, they're going to want their cut. And their cut comes in the form of an RMD, or a required minimum distribution. And in this video, we're going to get into what an RMD is and how it could affect your tax bill when you are retired. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And depending on when you were born, the IRS is going to force you to take money out of your pre-tax retirement accounts. The money that they force you to take out of these accounts is going to be subject to income taxes. Understanding how RMDs operate and how they can affect your retirement income plan is how you can either lessen that tax bill to the lowest amount possible or avoid it altogether. When it comes to RMDs, the first thing that we need to understand is how your RMD is calculated. And the way that the RMD is calculated is the IRS takes the total value of your pre-tax retirement accounts and divides that by a distribution period. The distribution period is all based on how old you are. And what you see on your screen is the Uniform Lifetime Table. What this table tells you is, based on your age, what your distribution period should be. So as an example, let's say that we had a 73-year-old with $500,000 in their pre-tax retirement accounts. And this is at the end of 2023. To figure out what their RMD would be for 2024, we're going to take the $500,000 and we're going to divide it by 26.5. So if we divide the $500,000 by 26.5, this individual's RMD for 2024 would be $18,867. So what this means is that before the end of 2024, this individual needs to remove $18,867 from their pre-tax retirement accounts. The key term in RMD is required, and you are required to take these distributions out of your account once you hit your RMD age. So what happens if you don't take the correct amount out of your pre-tax accounts? Well, if you don't, then there's a penalty involved. So if we took that same individual with $500,000 in their pre-tax accounts as of 12/31 of 2023, we figured out that their RMD is $18,867. If they forget or they decide not to take out this amount of money from their pre-tax accounts, then they're going to owe a 25% penalty. If we multiply $18,867 by 25%, their penalty for not taking out their RMD is $4,717. That's a very steep penalty to have to pay simply because you didn't want to or you forgot. Remember, the government gave you the opportunity to save on your taxes when you contributed the money. Their niceness only lasts for so long. They want their cut. They actually need their cut. So if you don't take the money out of your account when you're supposed to take it, they are going to hit you with a penalty. Now keep in mind, there is a 2-year correction window. If you don't take out enough money from your pre-tax retirement accounts, you do have 2 years to correct that. The penalty, if you do take out the correct amount, is only 10%. So even if you miss taking out the correct amount from your pre-tax accounts, you can reduce that penalty down to only 10% as opposed to the 25%. So now that we understand how RMDs are calculated and what the penalties are if you don't take the correct amount out of your pre-tax retirement accounts, I want to show you how your RMDs could affect your tax bill. In this example, we're going to assume that we have a married couple who receive $36,000 in pension as well as $36,000 from Social Security. And the reason that I'm focusing on pensioners is because that's who I work with. What I have found being in the financial industry is that pensioners are typically underserved. And most of that has to do with the fact that they don't have a lot of investable accounts for financial advisors to work with. Because of that, they don't always get the service that they need. And that's why I enjoy working with them. But I digress. If we assume this couple are married filing jointly, the first thing that we need to do is figure out how much of their Social Security benefit could be subject to income taxes. And if you've watched our video on how we can determine if your Social Security benefit could be subject to taxes, you know the first thing we need to do is figure out their combined income. Combined income is AGI plus 1/2 of Social Security. For this couple, their AGI is the $36,000 that they receive from their pension. We're going to add to that $18,000, or 1/2 of their Social Security benefit. What this equates to is a combined income of $54,000. To determine how much of their Social Security benefit could be subject to income taxes, we have to compare their combined income to certain thresholds. For a married couple, any of their combined income from $0 to $32,000, none of that is going to count towards their taxable Social Security. Any of their combined income between $32,000 and $44,000, 50% of that amount counts towards their taxable Social Security. And then for any of their combined income over $44,000, 85% of that amount can be considered taxable income. If we take the $54,000, the first $32,000, none of that counts. From $32,000 to $44,000, half of that is going to count. So in their case, it's going to be $6,000. And then for anything over that $44,000 threshold, 85% of that is going to count as their taxable Social Security. So their combined income is $54,000. That threshold is $44,000. There's $10,000 above that threshold. If we multiply that by 85%, that's another $8,500 of Social Security that could be subject to taxes. If we add these together, their total taxable Social Security is $14,500. Now that we know how much of their Social Security benefit could be subject to taxes, we're going to figure out what their federal tax bill will be. So they have the $36,000 that they receive from their pension. We're going to add to that the $14,500 of taxable Social Security. Their taxable income in this case is $50,500. We take the $50,500, subtract from that the $29,200 for the standard deduction. This is going to leave them with a taxable income of $21,300. If we use this number and compare it to the federal tax brackets, anything from $0 to $23,200 is going to be taxed at 10%. Their income falls under that $23,200 threshold, so 10% of their taxable income is what their tax bill is going to be. So we take $21,300, we multiply that by 10%. That's going to give them a federal tax bill of $2,130. And that's not bad, especially if you're bringing in $72,000 of income. But what we want to know is what happens when that RMD comes into play. To show you how your RMD could make a drastic change in your tax bill in retirement, we're going to use the same couple, but we're going to also assume that they're the ones with the $500,000 retirement account. We still have to go through the same calculations. We need to figure out their combined income, which is going to be the $36,000 that they receive from the pension, but we need to add to that the $19,000 from their RMD. Now, I know the RMD we calculated was $18,867, but we're going to round it up just to make the math easier. To those figures, we need to add $18,000 for the 1/2 of their Social Security benefit. This is going to make their combined income $73,000. We're going to use this number and compare it to those same thresholds to determine how much of their Social Security benefit could be subject to income taxes. Anything from 0 to 32, none of that counts. Anything from 32 to 44,000, 50% of that amount counts. And then anything over $44,000 of combined income, 85% of that amount could be included as taxable Social Security. Their combined income is over $44,000. So we're going to take the $12,000 between 32 and 44. We're going to multiply that by 50%. That's going to give us $6,000. They're going to have $29,000 of combined income over that $44,000 limit. So if we multiply that by 85%, then an additional $24,650 of their Social Security benefit could be subject to income taxes. And this is going to make a grand total of $30,650. Now, that's not exactly accurate. If you remember from our video, only 85% of your Social Security benefit can be subject to income taxes. It just so happens for this couple, 85% of their Social Security benefit is $30,600. Now we can figure out what their federal tax bill is going to be. So we're going to take the $36,000 from the pension, the $19,000 from the RMD, and then we're going to add to that $30,600 for their taxable Social Security. This is going to make their taxable income $85,600. We're going to take that $85,600, subtract from that the $29,200 for standard deduction, and their taxable income is going to be $56,400. So we're going to take this figure and we're going to compare it to those marginal tax brackets from the IRS. Anything from 0 to $23,200 is taxed at 10%. Their income is over $23,200, so they're going to pay 10% on that full amount. That's going to equate to $2,320 in federal income taxes. Because their income goes over the $23,200, we have to look into the next tax bracket, which is taxed at 12%. Anything from $23,201 to $94,300 is taxed at 12%. If we do the math, this is going to equate to an additional $3,984 in federal taxes. If we add these up, their total federal tax bill, because of the RMD, is $6,304. And this tax bill is a significant increase from before when they weren't taking RMDs. The actual difference of their tax bills is $4,174. And all of that is due to the RMD that they had to take. So if we wanted to dive a little bit deeper, we could figure out the effective tax rate on that RMD. We could divide that by $19,000 and figure out that their effective tax rate on their RMD is 22%. Now, only having to pay $6,300 on $91,000 of income really isn't that bad. Your effective tax rate at that point is roughly 7%. But what I want you to avoid is the tax surprise when you do have to start taking your RMDs. For this couple, if they went from 1 year not receiving an RMD to the next year having to take the RMD, then they're going to be in for a shock when their accountant tells them that they owe an additional $4,100 in federal income taxes. Understanding how the RMD will play into your taxes is how you can avoid that huge tax surprise. You can at least be prepared for it. The other thing that I want to point out is that there is a very high probability that that couple's not going to pass away at the exact same time. If there's a period of time where one of them outlives the other, the survivor becomes a single filer when it comes to their taxes. If that were to happen and their income situation remained roughly the same, that single filer's tax bill is going to skyrocket. As you build your retirement income plan, you need to consider what your tax bill is going to be while you're both still alive. But you also need to take into account what your tax bill may look like when one of you passes away. I urge you to keep tabs on my channel. In the near future, I'm going to put out a video on tax-efficient withdrawal strategies. In that video, we're going to go over the tax considerations you should be taking as you build your retirement income plan. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that's creeping up on their RMD age and they haven't started withdrawing money from their pre-tax retirement accounts, then send this video to them. Maybe it'll make them aware of what could be ahead. But I thank you again for tuning in. I'll talk to you soon.